think we're live.
Hi, everyone. Welcome to our webinar today, and thank you so much for joining us. My name is Ting. I'm the Chief Client Officer and Partner at Endowus. And today we also have Sam Ree, our Chief Investment Officer and Chairman on the webinar to answer some of your more pressing questions on how you should invest during a market correction.
Hi, everybody. It's great to be here. Welcome.
Sam, if you could just go to the next slide.
Disclaimer, then this one.
Yes, so if you have any questions at all today during the session, please go to Slido, which is sli.do. Enter the code 456456, and you can put all your questions there, and we'll try to get to as many of them as we can today.
And if you're on YouTube, then you can go below. You can also, in the process, click like and engage us as well. But all the questions, we won't look at the chat on the YouTube, right, Cindy? We'll actually just use Slido.
It'll be a lot easier if you guys could put it all on Slido, and we will manage it from there. Go to our next slide. So I'm just going to give a really quick introduction on Endowus, and then we can jump straight into your market questions. So this is our company's mission: help everyone invest better so they can live easier today and better tomorrow. Next slide, please. So Endowus is a fee-only wealth platform for both your private wealth, which is your cash investments, as well as your public pension, which is your CPF and SRS funds. What fee-only means is that we are only paid by you, our clients, and not by any of our product providers, so that we can always be aligned to your best interests. We're backed by some very large global strategic venture shareholders, such as Lightspeed Venture Partners, SoftBank Ventures Asia, UBS, EDBI, Prosus, Singtel, and more. Next slide, please.
Just want to highlight that UBS is the biggest private bank in the world, and obviously their only investment in Asia Pacific, and the first one in the fintech space, is actually Endowus. And Prosus is owned by Naspers, which is owned by Tencent. And obviously, we're very proud to be Singaporean backed with EDBI, the Economic Development Board's global investment arm, investing into Endowus. So really excited by our investors who back us.
Now, we're very lucky to have built up the team that we have. We really built up a team with people coming from leading global financial institutions, tech companies, and consumer companies, including the likes of UBS, Morgan Stanley, Blackstone, McKinsey, Amazon, ByteDance, Dropbox, etc. I probably won't go through each of our profiles, but as you can see here, this is the leadership team in the company, and everyone is extremely aligned to what we're trying to achieve here in terms of our mission and vision. You could just go to the next slide, Sam. We focus a lot on 3 pillars, and which is why our clients choose us as their wealth partner. So we focus a lot on advice, access, and cost. So our advice is really based on strategic passive asset allocation. We don't try to time the markets. And all what we do is very data-driven and science-based rather than speculation. In terms of access, we want to give our clients access to the best institutional quality products. And what we try to do is stand on the shoulders of giants of these established fund management companies rather than try to reinvent the wheel. And the third pillar is cost. We've tried to lower cost at every level possible, because cost is honestly the easiest way to improve your investment returns. Here's the next slide. Just to elaborate a little bit on the access portion, right? We have teamed up with the world's leading fund managers through our platform. These are only some of the fund managers that we have onboarded, and our investment team works really, really hard to continue to find some of the best partners out there, where we do a lot of due diligence on the fund managers, their underlying funds, to find the best products that are suitable for the clients that we have. To the next slide. And before I pass it to Sam to answer our first question, I just wanted to add that it's been a really rough first half for everyone. And trust me, like we're both investors, and our company, a lot of us are also, I think all of us are also clients on our platform. So we definitely feel the pain of watching our portfolios go from a very decent, 2021 performance to losing a lot of gains in just the first 5 months of the year. So my first question to Sam here is that, what are we seeing as the major trends in the global financial markets? Because as we all know, it hasn't been possible to avoid many of the developments that have roiled the financial markets in 2022, like accelerating inflationary pressures, Fed rate hikes, and Russian-Ukraine war, etc.
Yeah, thank you, Cindy, and thank you everybody for joining us tonight. Today, sorry, we normally do webinars in the evening, and right now it's the midday webinar, so I'm a little bit disoriented, but great to be here, and thank you so much for everybody joining us. It really has been a very difficult year for everybody in the investment space, and there's no space where we have been spared. Normally if equities does well, fixed income doesn't. Sometimes equities does really badly and fixed income holds up well. Last year, that was the case where equities actually generated a 20% plus return, the green dot on the left. Whereas bonds actually started falling last year with rising interest rates and was negative slightly for the year. But this year is unprecedented in the way that we've had massive negative returns for both bonds and equities. But having said that, obviously equities is in the double digits. Bonds is around the 10% mark as a global aggregate, although we've seen certain segments do really badly. And this is, as you can see in this dot graph, very rare. It's not common. So it's a very unprecedented environment that we're in. And, I've been in this industry for 28 years. Since 1994, I've seen multiple crises and cycles, but I've never seen equities and fixed income have a protracted, extended period of negative returns like we've had this time. And a lot of it is because of the unique circumstances that we're in: COVID, Ukraine war, the rising interest rates, inflation. All these things are coming to a head, and that's something that is very unique. And so we need to unpack this, really understand what is driving markets, why it's doing this, and what are we expected to see going forward. So I hope that today's session will be helpful in gaining understanding and a better perspective of what's driving things and why. We can't give you a very simple answer to everything, but we'll try to explain as much as possible. But remember that this is coming off of a very aggressive 2021 in especially the equity markets, where literally we had virtually no correction all the way up. So we had one correction of 5%, but we pretty much, ended the year with a double-digit return. And really, ever since 2020 March COVID crisis, where the market fell 33%, we're nowhere near that. We're now down less than 20%, but we really had a very good year in 2021, and that's why this year feels especially painful, especially after 2 years of positive returns. And remember, even in 2020, after the 33% fall, we actually ended the year up positive. If you look at the breakdown, it really seems like nothing has been spared. The only thing that is up is actually commodities, for obvious reasons. And no one could have predicted that, right? Because commodities was a terrible performer for the past several years, over the past decade, but it's had a blowout couple of years. But everything else is negative. Bloomberg Global Aggregate, which is the broad fixed income index, equities, all country world index, the ACWI, even Bitcoin, crypto, people said, oh, we'll hide in crypto with 20% yield, and, it's not correlated with traditional assets. It's perfectly correlated with very risky assets, and it's actually a higher beta, which means that it rises more, but also falls much more. So it's a massively painful situation, and Bitcoin is the best performing crypto, right? And there's everything else that has done really badly in the financial market. So nothing has been spared other than commodities. And if you really break down commodities, a lot of it was just driven by single thing: energy, which is driven by oil. And utilities is traditionally seen as a defensive, dividend providing sector. Everything else is negative. But even utilities is hit by energy prices. So, over the long term, there's really nothing that has been spared in this downturn, which is very unusual. And obviously, what we couldn't have predicted is Ukraine, Russia. The war is completely out of left field in a very difficult environment. It's actually caused significant pressures on the supply side inflation, especially for commodities, especially for soft commodities and oil. And that has really hit global markets quite hard and has led to inflation surging and the reaction from central banks. And as a result, the derating of tech and growth in the equity markets as well. So, and the risk of default in credit markets is what spilled over into the fixed income market with rising interest rates impacting bond returns as well. Now, despite the rally, I do want to point out that everyone's chasing this commodity rally. But if you have a longer perspective, and that's really what's important, we're trying to be here. Endowus is your partner for long-term wealth building. We're not a trading platform. We're not, a single stock trading app. We're not giving you free Apple, shares. We're giving you really solid content, education, literacy programs. We're, providing really high quality professional advice. We're giving you institutional products and funds and platforms and solutions that will give you a head start. With the lower cost, as Sinting highlighted, we can get a head start. So Endowus is really about providing you with that long-term perspective. And to chase commodities now seems a little bit cautious. I mean, I'm a little bit cautious in general. We cannot predict the future, and commodities might continue to rally for the next few months. But over the long term, we do have to understand that unlike equities, which trends upwards, and unlike fixed income, where it doesn't go negative for too long, eventually the yield and the coupons come back to give us some returns. Commodities is a highly cyclical and volatile market where there isn't a trend. There's always a cycle. When it goes up, it comes down. When it goes down, it goes back up. So it is a trading and a cyclical sector. And we have to understand what this asset class is. Just like crypto is a different asset class, we have to understand, the characteristics of it. We have to understand what commodities is as well. And that's a cyclical, deeply volatile asset class. And just when you think it's going to go up forever, as we did in the 2000s, I was an actual metals and mining steel analyst, and we thought it was going to go up forever, but again, it crashed. And so we have to understand that long-term perspective. I think we already have a poll going, but there's some question on Slido about tech in China. So it's important to understand that there has been divergence in returns. So technology, especially Nasdaq, has done tremendously well. That's the top line. U.S. market has done exceptionally well, largely because of the tech. China peaked actually at the beginning of 2021 after the initial rebound, and since then it's actually been a massive underperformer. So we can question whether China is worth taking another look at from a valuation perspective. And obviously local China, tech-focused China especially has done poorly because of regulatory and systemic risk. And so really, I think when we look at China versus US, a lot of the people are just looking at valuations or looking at price movement and saying, hey, it's fallen a lot, maybe we should buy. But I think what the market is pricing in is the difference between a cyclical risk in the case of US, where the cycle may turn and therefore we should, sell, versus China, which is a systemic risk. Can Xi extend to a third term, political risk? What is the government policy on real estate and technology? Regulatory risk, whether the balance sheet of consumers in China is extended and therefore this is a major debt burden, unlike the US where, the consumer balance sheet is good. This kind of systemic risk is what has been priced into China somewhat. And if that's removed, then it's worth taking a look at. But we have to understand that the risk between the US and China is slightly different, and we have to be cognizant of that. Now, one other major trend that, Sini asked about the trends, but this trend of growth versus value. So growth has massively underperformed value. But this is the recent trend year to date. And you can see that there's been a big difference in performance. But if you look at the long term, again, providing you with a long-term perspective of growth versus value, you can obviously see back in 99, 2000, I wanted to show that because that was the tech bubble and growth massively outperformed. But from that moment in 2000 all the way to 2010, value outperformed growth for a whole decade. But from then to 2020, and actually because of COVID, it got extended and exacerbated to 2021. At the end of 2021, growth massively outperformed for another decade plus. And so the question we're asking is value coming back over the next decade, like it has done, a decade at a time? Or is this just a blip and growth is going to come back? So this fundamental, deep question, philosophical almost question, is actually really, really important. It's not just about tech versus non-tech. It's actually value versus growth. And it's a very important factor to understand. The long-term average, if you break through multiple decades, is actually 1.36. And we're still above that at about 1.75. So if this has to normalize to long-term trends, then we have a little bit more long way to go in terms of value outperforming growth. So we have to be understanding of that. But obviously, the biggest canary in the mine, the biggest elephant in the room is really about interest rates, and really it's about the US. And so we've seen a massive pickup in yields, and this is the most unprecedented move we've seen, and that is what's driving the market significantly. Back to you, Cindy.
Thank you, Sam, for that. The next question that we have is really at the top of minds of a lot of clients that I've spoken to, and also just from the poll that we've put on Slido. So you can see rising inflation is really, your number one concern with the markets right now. So we've lived in low interest rate environment for so long that, it's really caught a lot of investors by surprise by the speed and magnitude of the move. And as Sam mentioned previously, moves in the fixed income market have really been unprecedented so far this year. So Sam, where do you think interest rates are headed, and what is the impact of the Fed rate hikes on investments?
Yeah, no, I mean, it's always front and center, most important question. But just a plug on the Slido, if you guys can, you have the Slido event code here, but there's a ongoing poll right now. I think 26 people have participated, so please go in and click on it. I'm surprised no more supply of chicken hasn't done better. I would have clicked on that one actually. But so please click on the Slido poll and help us, and let's see what the result is at the end of this. But just interest rates is what everybody talks about, but there's a reason why interest rates are rising, and it's because of inflation. So let's not forget where this began. It really is all about inflation, and inflation rates, after decades of disinflationary forces of globalization, of the technological advances, et cetera, aging demographics. I think that inflation is clearly breaking out, and this is the CPI in the US, which broke the 8% threshold, which is phenomenal. But I mean, once again, a long-term perspective suggests that maybe many people haven't lived through this. I was born in '72, so I barely caught the end of that in the '80s, and then ever since then, interest rates and inflation has just gone one way, which is down, and that has been the driver of the big bull market in bonds and fixed income ever since. But we have been here before, so this is what the Fed tracks. This is as opposed to the consumer price index, which is what is popularly used across different countries. The U.S. PCE is the core price index, is actually the one that the Fed tracks and uses as the most relevant metric, and that one hit 4.95% recently. But in the past, it has risen as high as like 10%, which is phenomenal. A lot of it was driven by oil. And other passing on downstream, and the supply bottlenecks that induced in the 70s and 80s. But it's still rare to hit that 8% CPI or the 5% PCE level. So it's not like it's something that we're very used to. But if you look at why that has been such a high number, it really is a result of, first of all, the COVID lockdowns, the ensuing supply bottlenecks, whether it's shipping or manufacturing or logistics and supply chain and services, because restaurants and everything closed down too. There is a massive inflation that is induced by the supply side. So a lot of inflation that's demand side. If there's a lot of money printed and there's a lot of demand for stuff, and that's what's pushing prices up, that's more of a concern. But if supply side is induced, then if we solve the supply side issues, then it will get better. And the two biggest problems have been, obviously China, which has had COVID lockdowns. Thank God, Shanghai, after 65 days is opening up. But Ukraine war is another one that, as I mentioned earlier, which is a massive impact to supply chain and supply of goods, especially soft commodities and oil. So this is very different from a normal demand side inflation. And there are areas where inflation is starting to feel a bit sticky, like it's going to stick at a higher level. So labor force is one, because it seems like there's not enough labor. If you go to the US, there's not enough labor, and therefore they're paying higher wages. If you look at the tech sector in Singapore, there's not enough labor, and therefore we're paying higher wages. So there are areas in the industry where labor force is short. And so, a lot of it is government checks and fiscal, benefits. And therefore people haven't like really felt like they were working, they needed to work because they have some checks in the book. Also, like this whole, great resignation, people thinking about their life, and people working from home, and therefore people want flexible work, and there's less labor in general, and therefore that feels a bit sticky. The other thing is housing. So because of COVID, there hasn't been any supply of new housing for a while. So you can see that here in Singapore, but also, US and everywhere, that new supply of housing has been limited. And that's exacerbated pricing movement, especially in the popular areas. And that's what's, affecting price movements as well. But we have to understand that inflation is actually a statistic. It's a number that we track on a year-on-year basis. So it's March versus March last year, it's April versus April last year, it's May versus May last year. So if you look at the actual numbers year on year, if you have a high base effect, like you have a 10% print, then the next year, unless you have another 10% increase, you're not going to have that number, right? So with the low base of COVID, and then coming out, we've had some high bases, but we're seeing a lot of inflationary shocks. You're going to have numbers that are eventually going to come down. So if you look at throughout the past century, how many occurrences have there been of inflation being above 8%? It's actually one of the lowest, right? Because either you're at 9, 10% or 13% and above, or you're going to be 1, 2, 3%, which is the bulk of the past century. So it's not normal for inflation to be high forever, because you're going to have supply side responses. If there's enough price increases, labor is going to want to work. If there's enough price increase in housing, some people are going to want to sell. And if there's going to be enough price increases in products and services, there's going to be new supply to meet that. And that's the aggregate kind of macroeconomic kind of theory. And therefore, inflation cannot stay high forever. And so that will eventually come down. And in fact, the market-based US inflation expectations use something called the break-even rate. So this is the difference between normal US Treasury bonds and the Treasury bonds, which are inflation protected. So TIPS, Treasury inflation protected securities, or what we call inflation linked securities, versus the adjustable kind of inflation rate adjusted bonds versus the regular nominal price bonds. What is the difference is actually how the market prices in inflation expectations. So using these break-even numbers, you can clearly see that 5-year people have a higher expectation that inflation will be high. But if you go 10 years, which is the middle line, it actually falls. So people think that inflation will be higher in the short term, but it will eventually get lower. So, which is understandable. But the other thing is that people thought that it was going to go well past 3.5% and above, but now we think that inflation may not be so high for so long. So this is 5-year on. So not 1 year or this year, it's 5 years onwards. Is that going to be 3%, 4%, as some people have said, or is that going to be 2, 3%? And people are now starting to say that actually a lot of these problems could be solved over the next 2, 3, 4, 5 years, and therefore inflation may not be sticky high. But the base effect will kick in eventually, and what's more important is where the rates are headed. So, interest rates are a really important driver of financial markets and fixed income directly, equities indirectly. And so with consumer price expectations now starting to come back down beyond the middle of next year, people think that it will peak in the second half of this year, start to come down, and will start meaningfully coming down in the middle of next year. With that in mind, what is the expected increase of the Fed? And the economists, even recently, I was surprised at this data because I was expecting at least 3 or more. But it seems like the bulk of people expect at least 2 increases, if not 3. And you have to understand that the Fed increases don't happen in a vacuum. You can't just increase Fed interest rates. they have regular scheduled meetings throughout the year. So in 2022, there is a limit to how many increases you can do. There's 8 meetings. We've already had 3, and there's only 5 remaining. So in the first 3, they were behind the curve. A lot of people think that they should have raised rates in January, but they didn't. They didn't raise enough in March, should have done 50, but they did 25. And therefore, now they're way behind. And after May, where they increased by 50, Fed Chairman Powell clearly stated that they don't want to do 75, they'll just do 50. And so the market reflected that. But from there on, June, July is in the bag, 50 basis points. September, I think, will be another 50 basis points. Clearly, 1.5% addition will take us to around the 2.25 to 2.5% maximum range in September. And from there, if you price in another 50 basis points in the remaining 2 meetings, then we can get to a maximum of 3.5%. And I want you to remember that number, that 3.25 to 3.5% range. And the 3.3% kind of is the threshold between the minimum and the maximum that the Fed can increase this year. But if, for example, inflation starts to come down, if growth starts to decline, if unemployment starts to pick up, because the Fed has a dual mandate of 1, keeping inflation in check, but also 2, keeping employment high, so unemployment low. They have a dual mandate, one of the few central banks in the world that do. They need to look at the economic data closely. And if towards the end of the year, inflation comes down, employment goes up, growth slows down, markets are down, the Fed is going to slow down, is what the market expects. And that, I think, is very reasonable to expect. And so that 3% threshold is, I think, the max that this year we'll see the Fed move to, which is much higher than what we've seen in the past. So you can see that even in 2018-19, the Fed had massive increases we saw, right? And the quantitative tightening occurred. So they did quantitative easing and cut interest rate to 0 in 2008. They raised it throughout 2016 and 17 and cut the balance sheet, but they only reached 2.25%. So that was the peak of the previous cycle. This time, we're expecting it to go much higher. And in that scenario, what does the market do? S&P 500 actually doesn't do too bad, but it's not to the extent that we've seen this time, and the speed at which it's risen and market yields have risen much faster. And again, this is, during that period of interest rate hikes, we're not done yet. So we'll see how the S&P does. Bonds also doesn't necessarily do too bad. They have a mark-to-market impact, but because it's a slow rate hike, normally this is priced in quite quickly and then the market recovers. This time it's actually extended because we've seen such a sharp increase in rates that directly impacts the mark-to-market impact for bonds. So it's been a very, very unusual and unprecedented period. And again, no surprise, the growth sector, so the middle red, the biggest bars are the ones that are impacted the most from interest rate hikes. So world growth, the growth gets hit, IT, tech gets hit, growth and consumer discretionary at the bottom in the US gets hit. Those are the, usual suspects that get hit when interest rates rise. But the other consequence we have to remember is not just equities and fixed income. Rising interest rates in the United States leads to a demand in US dollars because it gives you higher interest rates now. And that has crossed the Chinese bond interest rates. And therefore, the dollar has strengthened. And that has major implications to emerging markets and other asset classes as well. And this is another reason why I think that, commodities and other, US dollar denominated assets are affected because the dollar has moved quite sharply because of the rate differential, the interest rate difference between the US, which is high now, versus Europe and Japan and everywhere else in the world. So we have to be mindful of the impact that FX has in investments as well. With that, I'll hand back to Sini, and we can see the results of the poll.
Thank you, Sam. And maybe just to follow up on, the backdrop that you shared about inflation, where rates are heading, my next question is really specifically about, our fixed income portfolios, which we also have quite a few questions on Slido about, So, why has our most conservative 100% fixed income portfolio dropped by so much? And just to give you some context, it's down about slightly under 9% year to date. When will the bond funds start to recover,
Yeah.
especially lower duration funds. And what are your thoughts on our income portfolios, which have also come off since launch, and what should we do about them?
Right. Yeah, I didn't include some slides on that, but I mean, great questions. Let's start with the fixed income market overall. So we have to understand that, as I explained, interest rates have been falling for decades. Inflation has been falling for decades, and therefore bonds have had this massive bull run because bond prices move directly inversely with interest rates. If interest rates goes up by 1% and duration of the bond is one, for example, then it would rise by 1%. So bonds with this falling interest rates has had one of the longest bull runs in history. Also, we have to understand that we've actually seen this cycle play out before. So in 2018, bond yields rose, as I explained before, from virtually zero, post the global financial crisis, edged up slightly to 0.5, 0.75. And then 2017, we started the tightening. And then 2018, we had the Fed rate hikes. So we went to 3%, which is where we are now. So we've had this cycle just 4 years ago. Now, this would have been a normal cycle, but COVID was the one that really hit us because then we went back to zero. We had quantitative easing, massive quantitative easing, but also fiscal response. So a lot of checks and money was spent. And therefore, that has really distorted the markets in a meaningful way. Now, if you look at where long-term yields are, and with long-term yields, normally we use the US Treasury 10 years, and that has historically been high, as you can see. Even pre the global financial crisis, it was at 4 or 5%. That was normal back then. And during the financial crisis, it went to 2% market yields, long-term treasuries, and then rebounded when the economy recovered. And then since then, we've seen it like gradually decline. And 2020, when the Fed cut aggressively, it actually fell the lowest in history. And from there, we're just normalizing and then seeing the rate increase back to 3%. So it's not unusual if inflation stays high to see long-term yields rising back to 4% maybe, or even 5%. It doesn't have to stop at that 3% threshold and maybe go up a little bit more. It can. So we're mindful of that. And so long duration bonds that have long duration of 4, 5, 7 years will be affected. But the bulk of the loss has been realized. So the move from 0.5 to 3% is a 2.5% move, right? But it's a 75% move, right? But from 3 to 4% is just a 1% move. So, I think the delta in terms of the risk of fixed income is much less now because the interest rates have moved so sharp. And it's unprecedented how quickly they've moved up. And that's why the losses normally that are extended or recovered because of coupons and other interest rates doesn't get fed through. And all of it is mark-to-market losses on bond pricing that has occurred in the fixed income market. And so that is what's driving fixed income underperformance. But now, if you look at the short end, because I realize that there's a lot of questions about short duration, and also cash smart on the Endowus platform is affected by short duration. This is also very highly unusual to be above 3%. And because this is, especially at the short end, this is 2 years. Every short duration is less than 2 years, some of it less than 12 months. And so this will be much lower at 2% or 2.5%. And I showed you the curve at the beginning, but this has already started to come down. And I don't think there's a lot of room from 2.5% to going to 3% is a very, very small move. So the mark-to-market impact has been painful. It's gone from virtually zero to virtually 3% in a space of like 6 months. And this is what's been driving the unprecedented performance of the short duration bonds. The impact of rate increase on fixed income is quite easily measurable, as I said. Interest rates rise, bond prices fall, and therefore mark to market, you lose money. But then interest rates rise, and therefore you get the higher interest rate of 3%, 5%, 7%. And if you get that over a year, 2 years, then that should make up for any losses of 2%, 3%, 7%, or 9%, wherever that period is, depending on the asset class. So depending on duration, whether you're in the 2 year, 5 year, 10 years, whether you're inflation protected or not, real returns or not, and then which sector you're in, aggregate like global treasuries, investment grade, convertibles, or high yield, affects this. But basically, if you look at the return year to date, the middle red line, or minus, and then you look at the average maturity, it's a direct correlation. It really is, just goes to show that it's not about credit risk. It's not about any other market risk or default risk. It really is purely interest rate risk. And the increase in interest rate and the duration or the maturity here is a direct correlation. So the sectors and term premiums that have been affected the most are the ones that have the highest duration or maturity on them. So this will return once the market turns. And just, maybe just to oversimplify this is a short-term perspective of fixed income corrections. We saw it in 2018, as I said, as interest rates rose. That cycle of interest rate rising 4 years ago is when fixed income, came down quite a lot. Again, in 2020, when COVID crisis hit, everybody bought US Treasury and then realized, oh, crap, everything's going to, this is going to be the end of the world. And so everything fell and everybody sold even the safe assets, and because there was a liquidity crunch, and therefore the treasuries fell and fixed income fell. So that was a sharp fall from the peak, but that was an artificial spike and then a big drop, and then it came straight back. So a very short period. But this is unprecedented in the nature, the extension, and the size of the magnitude. But having said that, if you look at it against the long-term perspective of bonds and fixed income, it's actually not, horrendous. The long-term trend is still intact. And that's really important, especially for short duration, because short duration, this is the long duration. Global ag has a typical duration of about 7 years. This is short duration of maybe 2 years or less. And obviously you can see that short duration, the reason we put cash smart, ultra and some of them in the short duration is because of this, that long term, it shouldn't give you a lot of losses. And this recent loss is unprecedented in nature and very rare. It really only occurred very briefly during the March 2020 period and in the 2008 global financial crisis. But this is worse than both those cases. So this is the worst ever short duration performance. And therefore, you have to wonder whether this is an opportunity as well. And so you can see in a shorter time period, the magnitude of the fall and the fact that it's starting to bottom out and short duration bonds have started to perform recently. But the bond and fixed income space, I think we should not throw it out completely. The 60-40 balanced portfolio, everybody says every decade, every year, people say it's dead, but it comes back. And the reason is because bonds do exactly what it's supposed to do, which is you buy it at 100, you sell it 100, and you get the interest rate coupon, as long as the company or the government doesn't default on you. So the 3-year rolling returns of treasuries, short-term treasuries, which is the light green, the government bonds, the treasuries, the safer ones, which is the bright green, or the blue, the credit, which is the corporate bonds, whichever one you turn to, if you invest for 3 years rolling, you've never had a negative return. So the best case is 10, 20%. Worst case is flat to 1%, 2%. Versus equities, which are S&P 500, Russell, obviously you have higher upside, but also higher downside in a negative worst case outcome. So bonds do exactly what it's supposed to do. And if you extend your investment horizon in bonds to 2 years and plus, you would never lose money. And so that's the idea of why bonds are still attractive as a diversification tool. Back to you, Cindy.
Thanks, Sam. And you know what? I think that last point that you made really is very important for investors to think about. What is the role that bonds or fixed income really plays in our portfolio as a whole, right? We should always look at our portfolios as a whole and think about asset allocation and the importance of diversification in it. But moving on, there's been a lot of talk in the market about an impending recession. And Jamie Dimon, CEO of JP Morgan, yesterday came out to basically say to brace yourself for an economic hurricane. Although he then caveat that with, while conditions seem fine at the moment, no one knows if the hurricane is a minor one or Superstorm Sandy. So Sam, do you think we will be in a recession soon, or even worse, stagflation?
Yeah, no, it's a great question, and it's top of mind. Stagflation, the number of occurrences of the story of stagflation has suddenly jumped. So we had it like towards the end of last year in October, And then again, this year from March onwards, we've had a lot of this because everyone's been focused on inflation. And then now economic growth slowing down and a potential recession, you combine that's stagflation. Recession chances, if you do, this is the Bloomberg MLIV survey that's done on a monthly basis with 500 plus investors. What is the chance of recession this year is still low, 15%, because what you need is 2 consecutive quarters of negative growth. And so US, just published, I think, a negative quarter, but, whether we'll have 2 consecutive quarters is a doubt, and probably unlikely. So then it's going to be fourth quarter and next first quarter. So most people, I think, are expecting a recession next year in 2023. Some people think that it may extend or actually be in the year after. But regardless of that, I think that the probability of US is being in a recession in the next 12 months, including today, has started to spike up. This the right chart here has started to rise. So it's above about 20-30%. But you can see that during the COVID crisis, it spiked up to almost 100%. And again, in 2008-9, it did that. But you can see that actually it's not a leading indicator. This expectation is almost tracking the real-time recession marker. So there's no leading indicator. It's a coincidental indicator of recession. And so it's really, recession is something that I think people are worried about. We priced it into financial markets early, and then it happens, and we're already past it almost. And that's why a lot of the data is very lagging. So economic data is lagging anyway, but especially GDP growth and aggregate data is even more lagging. It comes out 1 month, 2 months later, and then it's revised again the next month to a different number. So any way of forecasting markets with economic data is fundamentally false. It cannot happen because the data is so lagging. Markets are seen, financial markets and stock markets are said to be a leading indicator of economic activity. So like financial markets price in data, information, knowledge about what's going on around the world earlier, and therefore it's a leading indicator of the markets. And so, whatever happens in the market, if recession happens, the market's probably already bottomed. Growth is slowing. That's definitely clear because 2021 was a special year. We had that base effect where 2020 was a massive negative year because of COVID. So we had a high number in 2021, naturally. We averaged the two, it's a flat line from 2019 into 2022. But we are expected to see growth slow because of multiple factors of inflation, of concerns about outlook, consumer confidence, unemployment, etc. But the fundamental data that's underlying the economy, especially in the US and even large part to developed markets, I would say that emerging market, many countries are struggling right now because of inflation and supply chain issues. But US and developed markets surprisingly resilient, and unemployment rate is relatively low. Odds of a recession in all surveys seems to be picking up again here, similar to the other one, but it's not that high. But consumer confidence is actually at cyclical lows. This is a long-term trend from the 70s to 2022. And you can see that the recent number published by the University of Michigan Consumer Sentiment Index is at the lows of 2008 global financial crisis, at the lows of the 1979-80s when oil prices went, $200 or something, and inflation was running at 15-20%. Those kind of situation lows, which is surprising. And I think it's a testament to the concerns that people have, whether it's COVID, whether it's prices, whether it's job security, whether it's the future outlook of China or markets. It just consumer sentiment is really low. But there seems to be a bit of a gap there. And one of the biggest things that we look at is, this is not a global financial crisis, guys. The consumer balance sheet is at the healthiest it's ever been. Even in Singapore, I think consumer deposits is at a historical high. Consumer balance sheets are at a historical high because of the government support with income, the fact that we haven't been able to spend much, our credit card, and our debt's been paid down. So yes, mortgages bigger, rents have gone up and costs are rising. And so we're concerned about consumer sentiment. That's what's being reflected. But the reality of our balance sheets and our income and our job security in terms of employment actually is solid. So this is not a global financial crisis. is nothing like the 2008 balance sheet crisis we had. It's maybe much more similar to the 70s crisis of inflation, but again, slightly different because we didn't have the structural problems that we had back then. And the other thing that I would add is that earnings have actually been surprisingly good. And maybe it's because of inflation, but earnings versus expectations have surprised for 7 consecutive quarters now. The companies, especially the listed companies, and remember the stock market is not your corner coffee shop or your chiropractor. I'm sorry if I'm offending anybody here, but it's not your smaller businesses or SMEs. It's actually proven companies with global reach, oftentimes that have great business models and a fantastic ability to generate profits. These companies are actually doing better than expected in terms of earnings. Admittedly, expectations have been lowered, and it's beating lower expectations, but nevertheless, it's still something that I think is still positive for the markets. Back to you, Sini.
Thank you, Sam. So given the macro backdrop, and obviously, nobody can predict where the markets will go in the short term, markets have really proven to be very humbling. Do you think we should sell now and wait to re-enter at lower levels, or do you think it's a good time to average down? And Mark Twain has said, history doesn't repeat itself, but it often rhymes. So what are some things that we can learn from past market cycles for today?
Yeah, wonderful. And it's always tempting, isn't it? Because we want to be heroes, we want to sell at the top and tell everybody we sold at the top and markets are going down and have this Schadenfreude feeling. But and then picking bottoms is like we say it's a dirty business, but it's actually something that is an impossible business. But it's something that we're tempted to do. We want to pick it up at the bottom and say, hey, I bought the bottom of the market and now it's gone up. I made money. I'm a genius. But the bottom line, as you said, Sini, is that we are human beings. We have to be humble in admitting that we can't predict the future. And so, looking at aggregate markets and the economy is even more difficult. At the singular level, I can predict what I do or my wife will probably do at a high probability. My company, I can predict to a higher probability what will happen in the next month or 20 months. But if I aggregate that to tens of millions of people and their behavior, and companies, tens of thousands of companies and their future, and then we aggregate it up to the economies and the world and the global market, it is almost impossible to predict that with any level of accuracy and consistency. Now, what I want to share with you is that I've been in the market for 28 years. I've seen multiple cycles. Look, there are things that are normal in a cycle, and this is a normal cycle still. Inflation, the rapid pace at which interest rates have risen are abnormal. Equities and fixed income falling at this pace, slightly abnormal. It's unprecedented, yes. But a lot of the features of this market correction are normal. Like drawdowns are a normal part of markets. So it happens every single year. Every year, more than almost 100% of the time, 5% or worse. Very rare for a market to go up in a straight line. 10% of the or worse, more than 60% of the time. And we've seen 20%, which is bear markets, almost 1/3 of the time. And so it is often easy to see drawdowns. Drawdowns, I mean by peak to trough falls in markets, not the annual return, which is a very different concept. And I'll look at this number to prove that, because oftentimes intra-year the market falls, but at the end of the year, it actually ends up being a positive number. I can give you examples in 1998 where the market fell 14%, but ended the year up 25%. The most recent example of that is the far right, the 34% fall in markets intra-year due to COVID, but ended the year up 16%. So we don't know what the market will do this year. And, most likely we'll see a negative return because we've had so many positive return years. But it's different if you annualize it. So don't sell at the bottom is, what everybody wants to avoid, because that's the one thing that is the worst thing outcome. But if you sell when markets are down, you're likely to sell at the bottom. That's the first message. Recessions, as I said, recessions happen in a lag with information vacuum. Into 2020 March, you could predict a recession. It was obvious we were going to see a recession, but did the economic data show it? Did any market data show it? No. The only thing was the market down 33%. And so that proved that the recession was coming. But when the recession hit, the market actually went up. So during the recession is actually probably the worst time to be selling stocks because the market's probably already priced it in and is already rebounding. So if you look at the historical data, and I've shown this data before, that prior to a recession, the market actually is flat, 3 months before, 6 months before. During the actual period of recessions, which is the 2 quarters of negative growth, the market is actually flat, up slightly 3.8%. Afterwards, it rebounds and obviously goes up a lot. But at some point, before, during, after, at some point, there is a intra-year or peak to trough fall, max drawdown of 30% on average. So yes, the market does fall. But if you slept 3 months before the recession, woke up a year after, you're actually up 15%, and you wouldn't have had to deal with all the emotional roller coaster. And this is why people say, look, just invest passive, dollar cost average, the monthly regular savings, look through this volatility and invest for the long term, because we're going to have to do that anyway. As long-term investors, we're building wealth, saving our CPF, building our retirement nest egg. This is what's the most important thing to understand. And trying to time the market, as I said, is a really, really difficult task because the biggest market rises. So the increase in markets, the market days when market gives you the highest returns, normally follows the biggest loss days. So market falls very sharply and then rebounds very sharply. We recently had that case of China Internet KWEB ETF where it fell like 20%, 10%, and then rebounded 40% the next day. And that was because normally when there's excessive selling and it happens during a period of lack of liquidity and no buyers, so it falls very rapidly, normally that's seen as an opportunity and people pick it up. So if you miss those big rallies that normally happen after big falls, and you have to get that perfectly right. If you look at this data between 1997 to 2021, missing just one best week reduces your returns by almost 15%. If you miss the best month, you reduce it by 20%. And if you miss the best 6 months, during this, 25-year period, you actually almost, go down by 40% in terms of returns. So I think that, you cannot pick the bottom. The best way to be in the market and be, gaining that day of the biggest rebounds is to stay invested in markets. And so this is another data point that 1 year, obviously equity markets can go up 58% in a best scenario or go down 48%. But if you hold it for 2-3 years, let's say 3 years, the best you can achieve is only 24% on a 3-year rolling basis. But the worst outcome also diminishes to 15%. So there's never a case that you lose more than 15% if you hold equities for more than 3 years. But if you hold it for 10 years, during this period, the worst outcome is plus 3%. So if you hold for 10 years, you would actually never lose money. So right now, I hope is another opportunity that if you can hold for the next 10 years, you'll probably not lose money and in fact be able to generate upwards of 13%. But on average, normally, if you hold for the long term, you gravitate to the mean, which is 7-8%. And similarly with fixed income, again, beyond 3-4 years, you'll never lose money. Back to you, Cindy.
Thank you, Sam. These messages of investing for the long term, diversification, don't try to time the markets, they sound very simple, but they are often easier said than done because, we are our own worst enemies when it comes to investing. And it is really challenging, not to let your emotions get in the way. And so for Endowus, our job as a wealth advisor is really to handhold you through some of these difficult times. And you can always, reach out to my team. We're all licensed client advisors when you need some help. So you can email us, support@endowus.com. You can WhatsApp us, or you can set up a call to speak with some of our advisors as well. And I'll share the link at the end of the presentation.
Yeah. Great. Actually, that reminds me of a Warren Buffett saying where, people are asking, what do you do when markets are this volatile? He says, I would tell investors, don't watch the market, basically.
Yeah.
Right.
And
use the emotions. Yeah.
I mean, I wish we could all invest like Buffett, but we can try and learn from, some of his wisdom. Sam, so what are some of the areas or themes that investors can invest in today to maybe weather the current volatility and inflationary pressures? And maybe just to add on to that, should we also look at some areas that have fallen a lot? I know you addressed this briefly in your first question, but we had some queries on Slido as well. Should we look at China? Should we look at tech? Is it a good time?
Yeah, no, I mean, we're always searching for the next best thing, right? And how can we hide from this volatility? As I said, I think that sometimes our emotions get in the way, and this cycle that we actually go through. This is a behavioral issue that we all face, and this is a typical chart where people go through a cycle of emotion, elation and optimism when markets are going up, and then euphoria, and then anxiety, denial, despair, and panic, and then you capitulate at the bottom. So this is something that people say, and normally people don't always have to follow this. This is what historically we've done, and therefore we've learned from this, and we've improved our behavior in general. That's why passive investing is important. Why this is why people understand the benefits of diversification. But really, it's about doing what's right for you, right? Having a clear, defined plan and sticking to them is really, really important. And so, I think just remove the emotion a little bit. I think this chart is very messy, and our investment office team have put this in. But answers to inflation and growth, because people ask this a lot, and it's good to understand. And I saw a question about REITs earlier, so maybe this will answer it. REITs actually does poorly during inflation, right? You can see that on the right bottom side. REITs is high beta, so it's highly leveraged to economic growth, and also it's negatively correlated to inflation. So inflation goes up, it does badly. And so REITs is not a good space to be. But worse is EM equities and US equities, right? Equities in general have done poorly. It's highly leveraged to growth. So if growth is great and inflation is high-ish, then actually equities does really well. So this right side is about recession, economic growth, and if earnings are good, then equities will actually hold up or will recover. And especially those companies that do have economic sensitivity, whether it's commodities, consumer banks, and financials, which benefit from rising interest rates, they will do well within that sector. The negative correlation with inflation, the positive correlation with inflation, negative correlation with interest rates, obviously is things like gold and commodities. But actually, EM bonds and EM currencies actually doesn't do too bad. And so emerging markets in general is something that I think we can start looking at again. And then, obviously, I think so. Equities, as I said, is at the right time is another. If growth is better than expected, not that it's even if it's negative, it's better than less negative. Is the delta that drives equity markets, and if it's better than expected, then I think equities will still do well in terms of valuation, because a lot of people ask about valuation, especially these days. In fixed income, you can clearly see that there are areas where things are starting to look a little bit attractive. EM debt, local currency, massively hit by US dollar. Default risk like Sri Lanka. A lot of these countries are suffering from food prices and oil prices, and therefore, we could see default in emerging markets, and that's a concern, especially for the fixed income market. For local currency, but US dollar currency is still expensive. Other areas like investment grade corporates and EM corporates investment grade actually still looks like an attractive value proposition. Muni bonds, for example, because the Fed is going to start tightening, and they will buy less treasuries and muni bonds and those likes asset-backed securities. They may feel some pressure, additional pressure, maybe it's priced in. So those are some areas I think in fixed income we can look at. And then in equities, valuation wise, obviously emerging markets is not as cheap as we thought. So it's become cheaper, but it's just in line with long-term averages. But places where valuations are cheap and below long-term averages is obviously Japan forever, Europe recently, and China are cheaper. So these are areas that we can look at. But I would say that the fundamental belief that we have at Endowus, that diversification is the only free lunch in finance. These diversification benefits are still relevant. So it's very rare for fixed income and equities to both do badly. So fixed income is a space that I think we'll start looking at, and diversifying your portfolio, because we cannot predict the best asset class every year, is important. And then this data we just wanted to share, because if you had invested in passive global markets versus the 244 active global funds, only two managed to outperform during this 5-year period. Two out of 244 active funds managed to outperform. And so the case for passive is stronger than ever. Even though it's negative this year, I think that we still need to diversify, be globally sectorally diversified, but also be passive in our return. The saving grace, I think that many people asked about this, but Endowus versus everybody else, we espouse a passive strategic asset allocation. So the Endowus 100% equity performance, for example, compared to the MSCI ACWI, All Country World Index, not world, guys. MSCI World is a developed market only index. MSCI All Country World Index is the global index, including developed markets and emerging markets. And so Endowus every month will track. If it goes down, the index goes down, we'll go down. If it goes up, we'll go up. But it will largely track, but we've outperformed the benchmark because of our factor exposures. Remember, we work with systematic quant factor investors that expose our portfolios to the systematic, long-term, proven factors of returns, which outperform the benchmark slightly, like value and quality and small companies. And because of that, working with Dimensional as our strategic partner, we've launched our factors portfolios, which are systematically exposed to these factors. And that's why the 100% equity portfolio did slightly better than the benchmark. But we've done significantly better than all other competitors, like the robos out there, like Saif and Stashaway. 100% equity have significantly underperformed, especially Stashaway, and largely because they're very active in managing their asset allocation, and they've done very poorly as a result of it. So just going back to the options that we have, I think that within the Endowus portfolio, we give you a holistic approach, a total wealth platform, so that everybody can get something that they want. So the core portfolios, which are globally diversified, low-cost portfolios, flagship, which is the best of both worlds, ESG, values-driven, and factors, which gives you proven factor returns. You can do any of those, and these days, especially, factors have obviously outperformed somewhat. But flagship is something that is where everybody gravitates to, and as you can see in the previous slide, it's done really well. And within the satellite, as I said, I think real estate's been suffering. China fixed income suffered. Technology obviously has been very bad. Low volatility fixed income has outperformed, and I think that some of these valuation arguments are still in place with some of these sectors and thematic ideas. The final thing I would say is income. So income portfolios are stable. Income is 100% fixed income. Higher income is really to achieve higher yield. So it has 20% equities and really higher yielding fixed income products. Those two obviously impacted by fixed income market correction. Future income obviously has 40% equity and 60% fixed income, and therefore you want more capital appreciation, especially if you're younger, so that you can have higher income payouts in the future. These kind of products have all suffered because of the collapse in fixed income and equity market. So the mark-to-market losses are there. So we're down like 9% on average, I think. But the income piece, which is what we've designed this to provide, has not changed. So your monthly payout from stable income, higher income, and future income has been remarkably stable. And some of these products, like PIMCO Income Fund, just recently, just last week, told us that the yield will increase from 4% level to 5% level because of the high interest rates. So in fact, we can start generating higher income on the same portfolio as new investments are made into higher yielding. So the total return, including payouts and the mark-to-market losses that will start to recover, will mean that income you should not worry about. This is for the long term. Otherwise, you should be in core portfolios or satellite portfolios. Income is really about, really focusing on the payout that you receive every month. And that payout has been very steady. In fact, may increase in the future, but it's exactly where it should be every month, week in, week out, every month, every month. So just be, hold steady on the income side, because that's the most important thing. Just one key, just background on the flagship, on the performance, because I think some people have talked about performance, but across the board, because equities and fixed income has done poorly, until the end of April, we've continued to see equities and fixed income both being down. But obviously, we can see that it's actually outperformed the benchmark index because of the numbers that I've suggested. And so, if you are investing for the long term, building a retirement nest egg, you should continue to monthly have a regular savings plan, because you cannot pick the bottom. And so investing more means that you can invest, and the market falling means that you can invest more into your future. And if you're in your younger years, like 30s and 40s, then you actually have only invested for 10, 20 years, and you probably have another 30, 40, 50 years ahead of you. So it actually is in your favor for markets. I know it's difficult to accept, and I'm older, so it's painful. But you should actually look at it from a very logical perspective, that you're actually buying the same assets at a lower price. This is the way Warren Buffett would think: is buying the same asset that you bought at a lower price is a bargain, so you should put more money in. And when it recovers, that's when you'll reap the benefits of the long-term investment. So with that, I'll hand back to Sini.
Thank you, Sam. We just wanted to share with everyone on the weekly Experience Endowus sessions that the client advisors host. So it's every Friday at 12 o'clock, where the advisors will walk through the Endowus platform, share any new features. Especially for those of you who are newer to Endowus, this is really a great chance to see how our platform works. And if you have questions for them, they can also address it on the spot. So that's the QR code, which you can scan to register with a link to schedule a session, or you can visit that link below, endowus.com/financial advisor Singapore. Yeah. Sam, are there any sort of last minute questions? Because I know we are coming up to time that you want
to understand that the time is bad. Do you see anything there? So one question on factors versus different core. I think maybe I can just go back to that slide and maybe answer some of the questions. I think one of the things that we talked about was, if you're unsure, then you should buy the flagship. That's the basic core investment. It's the best of both worlds. We have largely passive equities plus factor-based equities, which give you broad market exposure, slightly outperforming the index. And then you have fixed income with an active fixed income manager. And the reason we like active and fixed income, especially large, good fund managers, is because more than half of fixed income managers actually tend to outperform the benchmark. And that's because fixed income is very different from equities, which is difficult to beat because the market's kind of trending up. Fixed income is actually finding scale economies and opportunities. And the cost of investing is really high. Cost of indexing is really high. The tracking error is high. And therefore, it's very difficult to meet the benchmark. Passive index investing is really the benchmark index. No one can get that. It's index minus cost minus tracking error. And the equities is very efficient in building a passive index fund that has low tracking error and low cost. And we're going to introduce passive funds and passive portfolios very soon at 5 basis points, 8 basis points, and 10 basis points. So really cheap. So reducing the tracking error and reducing the cost means that equities is very, very efficient. But fixed income has higher cost and higher tracking error. So you're always going to be index minus, and therefore it's going to be a lower performance. Whereas if you're an active investor, sometimes you can take opportunities to beat the benchmark. And 70% of those, especially for PIMCO and leading investors in the space, do well. So fixed income, we build with active fixed income and systematic quant factor-based investing fixed income from Dimensional. So that is a great balance. And that's why we can achieve that great return, is because the flagship is the core allocation, globally diversified across factors, the best in class, lowest cost. Now, ESG did a phenomenal couple of years of performance in post the COVID crisis, because it's biased towards growth. It's growthy, it's quality biased. And so it's held up better than tech and megatrends and other stocks. But growth ESG has suffered in this recent downturn because of the derating. But long term, I still think that ESG companies who are high quality, high governance, very conscientious, really care for the consumer, a bit like Endowus, I think that those kind of companies will do well over the long term, and consumers will be loyal and will be willing to pay up for that service and goods. And therefore, those companies will do well. So there was a bit of froth, it's come back off. And I think this is a good time to start looking at ESG again. Factors is pure factors. So if you like dimension or if you like factors, and that's what you go for, that's perfectly fine with us. That's why we built it. But if you are a general investor, flagship is perfectly fine. So go with that. And you will build, the satellite around it or income around it as you need. And then the final comment about cash smart. I know it's been a very difficult period for cash smart investors. All of us have cash smart solutions as well, and so we suffer, especially for ultra because of the short duration impact. But I hope that today's webinar has helped to, with your understanding of why this is an unprecedented kind of, exceptional period, and it's already started to turn. So if I was a betting man, I'm not. I would like to say that, maybe, cash smart ultra, we'll see a day, maybe not this year, maybe next year, I don't know when, but cash smart ultra delivers like 5% returns and helps all of us get back. But regardless, I think that short duration bonds are looking much more attractive than it was because it's at a much lower price point and interest rates are peaking in the short end. But secure is the product that you should go for if you don't want risk, if you don't want the chance of loss. And if you need the money in the short term, then cash smart secure is the one that goes up every day, slowly, every week, every month, never losing money. Even this year to date, it's never had a single day of negative loss. It's given you steadily 0.7 to 0.9, almost annualized 1% of returns, even for short periods, and it's daily liquidity. So use that as a source of daily liquidity or weekly, monthly liquidity if you're a short-term investor. So I just wanted to highlight those things. And then FundSmart is the fund platform where you can do a lot of DIY. If you're a sophisticated investor, if you're an accredited investor and want access to Partners Group, Global CCAF kind of, products or, KKR products and that kind of, please reach out to our advisors for accredited investor stuff. But FundSmart has wonderful products and the lowest cost among the fund platforms here in Singapore. So if you're buying a unit trust or a fund, you should always use the Endowus FundSmart platform. Move over all your money from banks and private banks and fund platforms for FundSmart. Sorry, couldn't help myself selling, but back to you, Sini. Thank you so much. And maybe we can just end with this slide again to invite investors and clients to access our wonderful client advisory team.
Yeah, and if you have any questions, please drop an email to support@endowus.com. And we're all licensed client advisors, and if there's any questions that we didn't manage to get to today, please let us know. Yeah,
thank you so much, everybody.
Thank you so much for joining us during your lunch session. Really, really appreciate it. Hope you have a good rest of the week ahead.